This morning has brought another barrage of negative economic data for the Eurozone, but this time it is Germany, not just the debtor countries that appear to be suffering as well. Are we exchanging what was once just a debt crisis for perhaps an even bigger economic crisis? Well, Paul and Richard are here to look at what's been happening. Paul, for a start, how important is that slowdown in Germany?
Oh, it's very important. The hope was that an economy that has a line out to the rest of the world in terms of its ability to export to these fast-growing emerging markets would continue to grow despite austerity in the rest of the Eurozone, and in some way sort of lead the rest of the Eurozone out ultimately. If the magnet for growth, if the country that's supposed to drag you out of all of this,
the engine, basically.
The engine for growth is stuttering to quite the extent it seems to be at the moment, then almost all hope is lost, unless you change the way you were doing things.
Absolutely, but it's interesting, Richard, because of course one of the countries that he was depending on, Germany was depending on, was China, and now look at China, it's not growing as fast as everybody thought it was going to.
I think that this is part of a bigger global story in that we've seen sort of economic data come in disappointingly across the world lately, particularly in the US, China, and therefore perhaps it's not so surprising that Germany, which is reliant on external demand, is performing so better. Domestic demand in Germany is still holding up quite well, and that's an important thing.
Well, what we are seeing, though, all of a sudden, is this policy response. I mean, Jens Weidmann, the Bundesbank president, actually coming out and suggesting, hey, maybe we could have a rate cut after all.
Yeah, I mean, it strikes me, though, as a little bit too little, too late. I mean, at the same time, and also slightly paradoxically...
Do you agree with that? A little too...
Yes, I don't quite see what a rate cut
I mean,
will do.
but they're signalling against it as well. I mean, they sort of show an increased inclination to do something that they've already said won't have a massive impact. Just really don't understand what they're trying to achieve with this.
But also we're getting suggestions here that, okay, fine, monetary policy, yes, we could ease that, but also they're now suggesting that perhaps too much austerity, we need to ease fiscal policy as well, both at the same time.
Yeah, I mean, I think that's been gathering pace over the last few weeks. I mean, we had these comments from Barroso yesterday, again, rather confusing. He's saying he still thinks it works, it just doesn't have enough political support to continue. I mean, if you think something works, continue with it.
It looks like none of them want to stick their neck out on this.
There does seem to be another current to the debate, which is that there should be a bigger push on structural reform, which I think is important. But it's debatable as to whether, having gone for austerity, to then ease off in the hope that growth will somehow magically recover when people can see that actually maybe you'll just have to do more austerity later. Seems rather... sense.
But what is interesting here, above all, is that despite all these concerns about the economy, and we've seen the euro softening, yields in the, I call them peripherals of debtor countries, are at record lows. People are still putting money in there. This doesn't really make much sense, does it?
Global liquidity, the Bank of Japan, the Fed, the potential for the BOE and the ECB to do something, the ECB probably less so, but still the calls are mounting for central banks to do things. And faced with zero returns on cash, very low returns on safe government bonds, corporate bonds, people are being forced to invest, and Italy and Spain are the beneficiaries of that. Now, that contrasts, as you say, very clearly with some of the economic developments, but the message has been don't fight the Fed or whichever other central bank may be pumping money into your market.
Actually, I think sorry if I can add, I mean, I think what you might get into a pattern of seeing is the worse the economic data, the lower bond yields become, because they increase the expectation that there will be even more cheap money flooding sometime soon. And can I mention, in addition to Italy and Spain, Irish 10-year bond yields are at their lowest level since 2006. 2006 was the height of the Celtic tiger. It just,
it does look bizarre, exactly.
Yeah,
that's
yeah.
Why.
But as Richard says, I mean, it's entirely driven by this flood of cheap money and the expectation that the worse things get, the more cheap money there will be.
Well, we'll just have to wait and see how they deal with it. Richard, Paul, thank you very much.